Hi, Dan Coatsworth here. We had a bit of breaking news that affects this issue of the podcast. Now, we've finished recording all the segments, all the interviews, done all the editing, all the other bits that go on behind the scenes. Just as we were about to hit the publish button on this episode, we had a bit of news that affects something that we talk about later in this episode. So rather than having to go out, re-record everything and delay this episode getting out, I thought I'd just give a quick overview about what's happened. So we can just keep the rest of the episode, but then you know at the start what's actually the latest bit of news. So we talk about a merger plan between Hickle and Trig. Now, this deal has just been announced that it's not going to happen anymore. It's been scrapped. Lots of investor pushback against it. So when you come to hear later in the show, and we're talking about this potential deal between Hickle and Trig, just note that it's not actually going to happen. So with that context, let's hear the whole episode. Thanks. Hi, welcome to the monthly bonus edition of the AJ Bell Money Markets podcast, all about investment trusts. I'm Dan Coatsworth. Joining me is Hannah Williford. Hi, Hannah. How are you?
Hello, I'm doing well. I'm trying to stay warm. We also have Tom Sieber joining us today. Hey, Tom.
Hi, Hannah. Lovely to be on the pod today.
And we've got some fantastic guests on this episode, including Ashley Thomas from Winterflood, who's here to talk about some suggested policies in the renewables industry and a surprising trust merger.
And we have Evy Hambro from the BlackRock World Mining Trust, who will be joining us to talk about gold, copper, and all things commodities.
Now, we're also going to hear from Nick Britton at the Association of Investment Companies about a few trusts that are attracting the attention of investors looking for steadier returns.
I know you're itching to get to that, but first up, we've got a couple bits of news we want to walk through, talking about investment trusts and starting with some very interesting manager change proposals. Tom, what's been going on?
Yeah, thank you, Hannah. So, there's sort of two bits of news, as you said. The first one relates to Murray Income, which is a investment trust that's based in the UK equity income sector. And it launched a review back in July, and they've just announced the outcome of this review. And it's bad news for the current asset management firm that runs the fund, Aberdeen, because it's losing the mandate to Artemis. And the reason they launched a review in the first place, which is usually the case when we have one of these exercises, is the trust have been underperforming. So to put that into a bit of context, if you look at figures from the AIC and Morningstar, it was, apart from two other names, the worst performer in share price total return terms over the last 5 years. So UK equity income sector is a very packed sector. There's a lot of names there. The two names that did even worse than it were Finsbury Growth and Income, where I think long-time listeners to this podcast will be familiar with the struggles that Nick Train, who at one time was a star fund manager, has been having there, and then a trust called Chelverton UK Dividend, a little bit less well known, but small cap focused, and that's been an area of the market which has been out of favour. So apart from those two, Murray Income is the worst performer. So in that sense, it's not a surprise that they've looked to make a change. The current manager, Charles Luke, has a focus on quality stocks. That's part of the remit or the approach of the trust, and obviously it hasn't been delivering. Artemis, based on what they do elsewhere, might have a bit more of a kind of value contrarian, sort of going against the market type tilt, and I guess time will tell if that can lift Murray Income up the rankings. It's another blow, I guess, in a wider context for Aberdeen, which has kind of seen its stable of trusts retreat quite significantly in recent times. The other change, it's quite a different story, but it's also a story of management change, and it's an interesting one, is at Crystal Amber. So this is kind of a small cap activist trust. And Saba, who I know we're going to be talking about more later on the podcast, has agreed to sell down a portion of its 26% stake in the trust. And that's linked to the fact that the current holder of the mandate, Crystal Amber Asset Management, has told the board it wants to resign. Now, actually, unlike Murray Income, Crystal Amber's performed pretty well. even if it trades at a pretty stubborn discount. It's actually the top performer in the AIC's UK smaller companies sector. So this isn't the same situation as we saw at Murray Income. Instead, it seems Richard Bernstein, who's kind of a veteran in activist investing and has been in place since the launch of the iPhone, so we're talking kind of way back in 2007, wants to do something else. I guess, after nearly 2 decades, that's understandable. So Saba's going to, as part of this kind of shift, is going to sell a portion of its shares to what I think is a fairly obscure name, really, in asset management. It's a business called Tarncourt, who in turn are going to take on the mandate, and they'll focus on deep value opportunities in the UK and Europe. Tarncourt, who I'd imagine a lot of listeners won't necessarily be familiar with, and certainly something I had to do a bit of reading on before doing this podcast, is run by a guy called Charles Dixon, and he's CEO of a name-quoted vehicle called Roadside Real Estate, which invests in, as the name suggests, things like service stations, retail parks. And he also co-founded a build-to-rent venture called Apache Capital Partners. So he's really had more of a property focus. So he's the guy behind this Tarncourt. One interesting sort of detail is it looks like they're going to continue to hold on to the one real investment at scale that's still in the Crystal Amber portfolio, because they've been selling off quite a lot of assets. It's a company called Morphic Medical. So they've created or develops this medical device called Reset to treat causes of type 2 diabetes. And although we're still going to see this change potentially at Crystal Amber, there does look like there'll be some continuity in the sense that there's a kind of a shared opinion that the best time to sell this Morphic Medical will be when it gets FDA approval for the Reset device and then gets access to the US market. So that's a milestone that's expected in a few years' time. These changes haven't happened yet. Shareholders still get the opportunity to vote on it, but as we're recording, no date for that has yet been set.
Thanks, Tom. That's really great info. And yeah, Saba seems to always be on our radar. But I will say, I think the most shocking bit about that to me is that we can now start benchmarking a long time based on when the first iPhone was released. I didn't realize that was so long ago. So good factoids there. But on the Saba front, it keeps on doing things that are quite significant in the investment trust world, and we are then just going to keep on talking about it. So, Dan, what's been happening now?
I want to talk to you about Smithson, which is quite a high-profile investment trust. It's a small to mid-cap vehicle for the asset manager Fundsmith, and it's proposed to switch from investment trust to actually just like an open-ended fund status. Now, obviously, behind the scenes, it's yet another trust where this activist investor Saba has taken a stake and has been pushing for change. So Smithson has been trading at a persistent discount to the value of its underlying assets. So moving to fund status should effectively it would remove that discount. The investment strategy proposed to be exactly the same. The manager's going to stay on. So you might think, okay, this doesn't. Why is this news? Why is this really significant? I think it could be a trigger for more investment trusts to seriously think about switching to an open-ended fund status, because Fundsmith is, as an asset management firm, is incredibly high profile. And Terry Smith is the CEO. He's the person who is deemed. You're talking earlier about one-star fund managers with Nick Train. Well, Terry Smith is also one of the most famous investors in the fund management industry in the UK at the moment. So I think that if decisions that he makes will definitely be sort of considered by other people in the same situation. So before I sort of go into sort of discussing this potential sort of domino effect that we might see, I thought it'd be worth listening to Terry Smith himself about what's going on. So I actually caught up with him the other day to talk about these proposals at Smithson. So let's hear what he had to say. And also, particularly the interesting stuff is about what role that the activist investor Saba had to play in this sort of bigger story. So Terry, you've announced some changes to the structure of the Smithson Investment Trust, moving to an open-ended fund. What's the driver for this decision? This is quite a significant shift to a product that was launched in 2018 Is this simply down to activist investor Saba Capital, or is it something else?
No, look, Saba has been the trigger for this, but that's because what they're saying is something we agree with. They're right, which is to say we launched this as an investment trust. It invests in small and mid-cap companies, so that you might think is a good structure for something that invests like that. But the problem is it hasn't worked. And, there's a great quote from Richard Feynman, the guy who was a physicist who won the Nobel Prize, worked on the Manhattan Project. And he said, doesn't matter how smart you are or how elegant your theory is, if it doesn't work in experiment, you're wrong. And so, it's a structure that we liked for this, and we devised using an investment trust for this, but it hasn't worked in the sense that it's been trading at a persistent discount. And when you've bought back 40% of the trust, which we have been doing buybacks, and it hasn't eradicated the discount, you need to do something different, don't you, really? Otherwise, you get onto another quote from another great physicist, which is Albert Einstein saying, to repeat the same action, expect a different outcome is a definition of insanity. So keeping on buying back shares wasn't working. So we've proposed switching to an OIC, to an open-ended company, because then there can't be a discount. It will trade at NAV, basically, and everyone at any time will be able to get in or out at NAV.
On the downsides to being an open-ended fund, i.e., if you go through a market downturn, you get redemptions from investors. They want to take their money out. The fund manager, the Smithson, will have to be forced to sell holdings. Where actually, on an investment trust structure, there's benefits for permanent capital.
Yeah, look, you're absolutely right, of course, about that. As it happens, I mean, the average company, the median company that we've got in the fund has got a market capitalisation of 8 billion, and the fund, as we speak right now, is under 2 billion. So there isn't any liquidity problem. If we thought there was a liquidity problem, we would not propose going to an OIC, because experimenting with liquidity of these things is playing with fire, isn't it? So we're confident we could do it. What the industry probably should gravitate to, but won't, is having open-ended funds, so you can guarantee anyone could trade at NAV at any time, but with different dealing periods. So instead of having daily dealing for everything which we've got now, having a dealing period which somewhat matches the underlying asset base. I mean, having a real estate open-ended fund with daily dealing is clearly nuts, as people have managed to demonstrate over time by having to gate their funds. We should really shift to having different dealing periods, but there's no sign of the industry doing that. I mean, if we were to switch to a different dealing period, we wouldn't be able to get onto a single platform in the UK, as you know.
Has there been any suggestion that actually it's just down to you're picking the wrong stocks? Not you personally, but obviously the manager for Smithson. Or is it, we could look at it that small caps are just out of favour in general?
I think if you look at it across the industry, not just in this fund, but there are other funds too, they're out of favour across the industry. And also, when you look at the discount, which is really the discount to NAV, which is what's driven this proposed change, the discount to NAV is prevalent across all the strategies in the industry just about. I can't think of one that hasn't got that. No, I think for good or ill, the tide in the industry is very strongly in the other direction at the moment. If you think, what's the fastest growing product area in the industry? It's ETFs. ETFs are the diametric opposite of investment trusts. They're a clue in the name, exchange traded. You can trade intraday. You're not even limited to once a day. So that's where the trend clearly is. And so at the moment, I think the problem isn't our particular fund manager or even the fact that the strategy is out of favour. I think the fund manager, Simon, is incredibly capable. The strategy is definitely out of favour, but the whole industry's got the discount problem.
So if the whole industry has a problem, isn't it just a case of history suggests you be patient, you wait. Small caps will come back into fashion, and also you're not really small. You're more mid cap really than small cap, isn't it, with Smithson? So surely it feels like you're giving up now when actually. Are you giving up at the bottom of the sentiment so weak towards small caps? Surely you better to wait.
Well, we're not giving up on the strategy at all. No. I mean, I would agree with you if we said we're closing down and going home now. We're folding up our tent and going. We're not. We're carrying on with the strategy. We're just changing the structure of the vehicle. And I think we're going for the structure of the vehicle because we can't see a way, notwithstanding whether the strategy is going to come back or not going to come back, to eradicate the discount. Plus, I mean, do bear in mind that we have got. If you think that we should be actually persisting with the investment trust structure in this. We'll put you in to explain to Mr. Bowes at Saba why that's a good idea, because he doesn't seem to think it is. And to be fair to him, he does have an investment in about 17% of the fund. So he's entitled to a view. And I don't think his view is wrong.
So with this, the restructuring means that anyone can sell at net asset value minus costs. Does that mean that Saba's that's their exit?
You'll have to ask them. I mean, they've said they'll support the vote. for this. What they do next is entirely up to them. I mean, they'll let us know in due course, probably because this is an act I would think they can repeat. Yeah.
Is there not a risk that you actually get a big chunk of investors who go, okay, I've been suffering at a discount, I can now get out at NAV, and then you're left with a very, very small amount of assets under management? Is that
depends what you mean by a risk. I mean, obviously it's a risk to us as a business, but it's not a risk to investors, which is what we should be thinking about here, isn't it? I mean, in the end, what we should be thinking about, we've got a duty to actually think about the investors, and I think giving them the opportunity to trade at NAV, all of them, not just some in a tender offer, but all of them, giving them is the right thing to do. And if it ends up delivering what you've described, which is an exodus in a smaller fund, well, I'm afraid that's a consequence of doing the right thing. But we're not going to not do the right thing.
Well, Terry, thank you very much for talking about Smithson.
Okay.
So I hope you enjoyed that interview. I was really surprised by how open Terry Smith was about the role that Saba played, because normally I would expect asset managers to be fighting off activists and sort of now obviously this does beg the question that if Terry Smith is sort of saying yes, they're right, what about other people? So I spoke to a company called Modular Finance. They kindly used their data system to pull me off a list of other UK listed investment trusts where Saba has a stake. That list is massive. There's just over 40 names. Many of them, it holds more than 10% stake. So really, that kind of position in the company means that whatever the activists had to say, you can be sure that the board is going to be listening. They may not agree with it, but they will definitely get their attention. Now, switching to fund status does solve this discount to NAV problem. So when I talk about this, a bit of a jargon there, the discount to the underlying value of the assets. But you do lose the benefits of having permanent capital. By that I mean, if an investor wants to take their money out with an open-ended fund, the fund manager has to essentially sell something to give them that cash back. With an investment trust, when an investor wants to sell, they simply sell shares in that company to someone else. The fund manager doesn't have to do anything with their portfolio. They can keep it invested. So I think that's a really big difference here. And so I thought, take a look at this list. You've got names like BlackRock, Throgmorton, Brown Advisory, US smaller companies, Fidelity Emerging Markets, and Worldwide Healthcare Trust. These are just some examples where Saba has a stake. So definitely ones to keep an eye on. And of course, we'll be monitoring the situation on the pod. And actually, we're hoping to get Saba themselves on the show in the new year to hear their side of the story.
Thanks, Dan. I think a lot of people will be surprised at just how many trusts are on Saba's shopping list at the moment.
Yeah, no, definitely. I think it's a fascinating thing, and I do appreciate we've been talking about this quite a lot, but this is big news for the investment trust industry, and it started about a year ago, and it's going to obviously continue into 2026. But let's bring on another guest now. So I know that last episode, Hannah spoke to James Carthy from Quoted Data about the renewable energy and infrastructure space, which is arguably deeply unloved. But annoyingly for us, just by the time the podcast was published, there'd been some significant news which had an impact on the sector. We had some proposals to change the measure of inflation in clean energy incentives. Now, that caused a bit of a sell-off in renewable energy shares. We then had the news that two big players in the space, so renewables and infrastructure space, might be merging. So to try and understand exactly what's the implications of this news, Hannah caught up with Ashley Thomas from Winterflood to hear about what's going on. So let's listen to that interview now.
We're here with Ashley Thomas from Winterflood, and we're going to go through all things that have been going on in the renewables sector. Even though we covered it on our last podcast, there's been a lot of updates since then. So a couple new things to talk about. And Ashley, I just wanted to start by asking you about these new kind of propositions for regulation changes that might be coming into place. I have a very layman's explanation for them, but I thought it would be better to check it with you. So the way that I understand it at the moment is we have these two different regulations, which is the renewable obligation certificates and the feed-in tariffs.
Yes.
And how I understand it is that these regulations basically give a bit of assurance by acting as certificates that they must be purchased, so it gives them some kind of regular cash flow. And basically, some of the suggested changes they're proposing would be to either kind of change the rate at which they increase in price or freeze that rate, which would obviously be a problem for that sector. Is that generally what's going on?
Yeah, no, that is the case. Thank you, Hannah. So I guess the easiest way to think about both the renewable obligation certificate regime and the feed-in tariff regime is that these were the subsidy structures put in place, in terms of ROCs put in place from 2002
Mm,
to support the deployment of renewables at a time when the technology costs were higher and they needed a premium price support over and above the wholesale level of the power price.
yeah.
But because they were brought in some time ago, they
Mm,
were linked to RPI as the metric of inflation.
right.
Historically, RPI has had a higher rate of inflation than CPI,
Mhm.
termed the RPI wedge, and we have progressively seen in a number of structures a shift away from RPI to CPI or CPIH or a number of the CPI series.
Right.
And so this proposal from the government, and at this stage, it is just a consultation.
Hmm.
So nothing has been decided. The consultation ends towards the end of this month on the 28th of November. The
Hmm.
government will then consider those responses and make a decision. And yes, you're correct. There are two options to either simply move from RPI to CPI from next April 2026, or option two, to reflect the fact that RPI has been higher in the past and higher since 2002, to effectively freeze in nominal terms
Hmm.
that level of subsidy
Hmm.
um, up to a time when RPI and CPI or that stable level of subsidy would have adjusted and corrected for that premium in RPI, and that is expected to be sometime in the mid 2030s. Sort of it depends upon assumptions, but
Okay.
broadly between 2032 and 2035. So yes, that is the consultation options under consideration by the government.
Okay. So not an automatic change, but something that will definitely be on these trust radar.
Yes, it's so option one, simply moving from RPI to CPI, doesn't have a material impact
Okay.
and would be in line with measures that have already been adopted, say within the regulated network industry. So
Hmm.
both water and the electricity and gas networks have already moved from RPI to CPI.
Hmm.
Um, and the level of impact on the UK Renewable Investment Trust is relatively limited. It's
Okay.
around, on average, it's around 2% NAV impact.
Hmm.
The second option of freezing the level of subsidies to the mid 2030s does have a more material impact.
Hmm.
Has around a 5% on average NAV impact, more in certain cases, and therefore we've seen a more material share price reaction for the companies that are more exposed to that.
Right. Okay. This makes sense. Yeah. And I wanted to ask you one of the trusts we're talking about today, which is the Renewables Infrastructure Group. You, I think, mentioned in your research note that it would have a pretty minute impact on them. Can you explain why that would be?
Yeah, so it's a combination of two reasons. One is that they're not exclusively UK.
Mhm.
So, over 40% of their asset exposure is in Europe.
Mhm.
So it has more geographic diversification than some of the other renewable investment trusts. And the other aspect is that, I spoke earlier that these changes are for the older subsidy regimes. Newer subsidies and for renewable subsidies, renewable power subsidies going forward. For example, in auction round 7, which is the subsidy round that is currently being conducted by the government, where there will be results next January. They are conducted on a different platform, which is the contract for differences. And the contract for differences has always been linked to CPI and therefore is not a part of this consultation. And so the other reason why TRIG, the Renewable Infrastructure Group, is less exposed is that even within the UK, a number of their assets, and certainly their larger offshore wind assets, are actually remunerated or subsidized through contract for differences, and therefore there is no impact from the consultation on rocks or fits.
Interesting. Okay, that definitely makes
Yeah.
sense.
So for Trig, the level of impact is only roughly 0.5% under option 1 and around 2% under option 2.
Okay, very interesting. And yeah, I guess that's definitely not the most notable thing that's happened for Trig in the last few weeks. So they have this proposed merger with HICL. What, how did this merger come about? And, it's quite clear to see the positive impacts for Trig, but what is the appeal exactly for HICL?
Yeah, it's an interesting time in the sector at the moment. Sort of how did it come about? So, I think for some time there has been a call from investors for the sector to potentially consolidate and have larger, more liquid vehicles.
Hmm.
The sector has traded at NAV discounts since 2022. And despite initiatives such as asset recycling and share buybacks, the level of NAV discounts, which for the renewable sector, on average are around 30%, the NAV discount has persisted.
Yeah.
And therefore, there has been either a number of companies, not just making realizations to validate the NAV,
Hmm.
and also to potentially return capital to shareholders.
Hmm.
But some companies actually conducting either broader realization, so wind down programs, or in the case of Bluefield Solar Income Fund, initiating a formal sale process for the whole of the group.
Yeah.
So why did this come about? That there has been a call for consolidation
Hmm.
that would create larger, more liquid vehicles.
Hmm.
I guess investors had expected that consolidation to be focused within the renewable energy investment trust sector. Yeah,
Right.
so
So
there
two of
are
those similar structures merging together rather than
yes, so
outside.
yes,
Yeah.
yes, so either a consolidation within technologies, so
Hmm.
either consolidation within the individual solar funds, or potentially consolidation within the renewable sector, but across technologies, because there would be a benefit from, say, combining a wind and solar portfolio,
Hmm.
because that would reduce the level of generation volatility and cash flow volatility. Often when it may be sunny when there isn't wind, but just in general, adding a broader a generation base that can be intermittent would reduce volatility. And it could be argued that by having lower generation and cash flow volatility, that could justify a lower discount rate. So I think there was an expectation of consolidation within the renewable energy sector. It has been a little bit of a surprise for HICL, which has a focus on core, largely economic infrastructure. So, for example, water networks or PPP, hospital or education, accommodation facilities, where the revenue base is far more regulated, availability based, certain. It's been a surprise that HICL has sought to have a strategic pivot and proposed to combine with Trig to add what would then be a material renewable component within the portfolio. Trig would be over 40% of the combined group assets.
Right.
So yes, investors were expecting consolidation, potentially not this specific match.
Yeah, it'll be very interesting to see if investors are willing to take that dive. So we will keep an eye on it, and I'm sure be in contact with you again soon about it.
Well, no, that's great.
Yeah, but I think that's fantastic for today, and a really great roundup of kind of what's going on in the sector and what to watch out for these deals. So thank you so much, Ashley. I really appreciate it.
No problem. Good to speak with you, Hannah. Thank you.
Thanks very much to Ashley Thomas again from Winterflood for coming on the show.
So the renewables sector might be very unloved, but we do have a sector on this week that has been the talk of the town. So the gold price has shot up this year, which has brought a lot of excitement to the metals sector. However, other parts of the commodities space haven't fared as well as gold. So let's learn a little bit more about why gold, copper, and other metals have been moving in certain ways and what that means for the mining sector. We're going to bring on our next guest, Evy Hambro, who's the co-manager of the BlackRock World Mining Trust and is a fountain of knowledge when it comes to metals, minerals, and the likes. Dan recently caught up with Evy to get to grips with what might happen with commodities in 2026, as you'll now hear.
So I'm very pleased to be joined by Evy Hambro, co-manager of the BlackRock World Mining Trust. So Evy, good to see you. Hope you're well.
I am. Thank you very much. And you?
I am very good. Thank you for asking. We got to start a conversation talking about gold. It's been a really good year for that metal. I was just wondering, is there a certain commodity you expect to sort of shine in a similar way in terms of sort of price next year, and why? And could it be gold again or something else?
Yes, I think when it comes to a commodity price change, you need to think about why it has changed or why it is likely to change. And so you therefore need to dig into the underlying components that have an impact in creating that outcome. So when you think about gold, gold's price is changing because there is a problem across the world, which is governments have too much debt. The interest cost of servicing that debt is rising inexorably. They have a massive social burden that they need to fund. They've now got defense bills they need to pay, et cetera, et cetera. So they are issuing more debt, they're printing more cash, and they're devaluing the purchasing power of paper currency. And therefore, gold is responding to that. So the faster that problem grows, the more the gold price is therefore likely to change. And so that to me is the kind of thinking. So if you think that, the issues in, I don't know, the UK are going to get worse, or US or Europe or whatever else, then gold's price in those currencies is therefore going to change to reflect the underlying problem and people's fear about that problem. And so what we've got is we've got a kind of global currency aversion trade going on, where people are increasingly losing confidence in the long-term ability of paper currency to buy you what it used to buy you, and they're looking for alternatives, be it equities, be it real assets, be it infrastructure, etc. And so that's what's going on in the gold market. That's the kind of macro view. On the micro view, then you've got supply and demand. What's happening in supply and demand is that the gold companies aren't producing much more, and there's a lot of buying by central banks who are aware of the problem, and so they're buying gold to diversify their currency reserves. And gold's moved back above the US dollar as a percentage of global central bank reserves for the first time in many decades, but still at a very low level relative to where it used to be at about 20% or so. It used to be kind of 60-70%. So there's a lot of kind of room to go in terms of growth and gold exposure in central banks. And then you've obviously got retail buying, you've got huge purchases of gold coins, gold bars. Costco in the US is sold out. It's extraordinary what's going on at a kind of more micro level. So the supply demand picture, from at the lower level, looks pretty good. And then you've got the macro, which is the size of the problem, how fast it's growing, and then what does that do to the price. When you look at other commodities, the kind of problem element isn't really there, although it is a trend around real assets. So in copper, you've got massive capex expenditure around the world related to AI. You've got all of the power infrastructure and support infrastructure, cooling, etc., that's going into that. Yeah, it's very copper intensive. So how that spend continues to grow will have an impact on demand. And so copper's demand growth rate is increasing much higher than it has been for many decades. It's gone up by at least 1, if not closer to 2% per annum higher than it normally is, which is like a 50% increase in demand growth rate. Supply is challenged. This year has been pretty much unparalleled in terms of the amount of disruptions. That's probably going to play itself out physically in the market in the first half of next year, and so copper looks quite exciting from that point of view. So the point I'm making in answer to your question is that different commodities have different dynamics, and so you have to look at those individual dynamics to decide where things are likely to go. In specifically answering your question, yeah, copper looks really tight. It could have a very interesting move in the first half of next year. Gold's trend is likely to be supportive. We're probably going to see that continue to move forward. Investor fears around the problem, that we call it in inverted commas, will go up and down, and the prices will change, to reflect that people's worries about that. So there's lots of different moving parts here, and that's how we're kind of trying to run the trust, to make sure that we're capturing those themes.
So I think when you have a high gold price, I think if you look back in history, sort of kind of tempted mining companies sort of dust off gold exploration projects or development projects that kind of only work when the price is high. I'm just wondering whether we're going to get the situation again where money goes in to develop new projects, but actually gold price pulls back a bit and suddenly we've got a load of assets that don't really stack up financially. Or do you think that actually the industry's showing restraint? It's not getting too carried away with what's going on at the moment?
I'm not sure I necessarily agree with the points made in the question. So, if you'd said copper or other commodities instead of gold, I would have agreed with it. So the gold price doesn't really have a dramatic kind of price elasticity of supply in the short term. In fact, most commodities don't have that in the short term. In the medium term, it does, but in the short term, it doesn't, because you can't just turn a tap and build these things quickly and increase supply. So, the gold price, and other commodities go up, but it's how much they go up relative to cost. So, when I started doing this job many years ago, the gold price was like $400 an ounce, or I think $300 an ounce. It fell to $252 in 1999, and it's been gradually rising, ever since. If margins expand too quickly and stay elevated for long periods of time, then assets that were previously uneconomic have a higher probability of becoming economic, and therefore they could be developed. But you've also got to look at the return on the capital that's being deployed in order to decide whether or not that's going to deliver the decision to build something. And take copper, for example. Today the copper price is $5 a pound. 25 years ago, the copper price was like 60 or 70 cents a pound. But the capital cost of building new projects has increased far more than the price has gone up. And so the return on the capital invested isn't any greater despite the price having gone up. So we need to see a price of like $6 or $7 a pound, to be able to act as a proper incentive to start that spending. When that spending starts, it will still be 3, 4, 5, if not 10 years into the future before that supply starts to arrive. That's a very, very long time when you think about most investors worrying about what's going to happen in the next minute in the markets rather than the next 3 to 4 years. So for us, we're investing in that kind of medium term picture. We're trying to get returns for the trust through the cycle, and obviously we're investing in the equities rather than the commodity prices. So for us, it's about, does this commodity price represent value in the equities? And right now in gold and in copper and a few other areas, there is an enormous amount of value out there.
So what sort of things, when you look for a company then to invest in, obviously you're looking very closely at its projects. Do you really want to see, scale counts here, the biggest project possible that'll have the longest mine life, and you've got economies of scale, or are you happy to look at companies that have projects with perhaps a short mine life, but if the economics are really attractive, it's worth it for you?
Yeah, so that's a really, really great question, but it would take an incredibly long time to answer it in detail. So what we try to do is build a portfolio that has different characteristics that, when added together, will allow us to outperform through the cycle. So we want exposure to high quality assets. We want exposure to high quality management, and ideally those two things mixed together is a great outcome. We also want companies that have got growth, companies that paid good dividends, the ones that have got strong balance sheets, the ones that have got exploration potential. Might sound like we want everything, but if you can get a mixture of that by having exposure to different companies that each provide an ingredient into the portfolio, that when mixed together, then you can actually create something that's very special. And that's what we try to do. We have listed companies, we have private companies, we have royalties, we make use of debt inside the trust. We try to pay the maximum dividend possible from the income that we generate. And I think by doing all of those things, from the equity exposure that we have, we can, in theory, deliver that superior return to the listed alternatives, being maybe an ETF that captures the commodity price exposure or a commodity equity exposure, or just going out and buying the individual companies that people might choose from, in the London Stock Exchange.
What just about on copper? Obviously, there's been lots of talk about saying materials is needed in energy transition. It's needed in sort of the backbone infrastructure for AI. So obviously the demand picture looks pretty good. You seem to be pretty bullish about the price, because I'm right in saying it's supply constraints certainly near term. Is copper, to me, then that's all the right ingredients to be very, very bullish on copper long term. But are there good projects out there which are worth, in terms of companies with good projects worth backing, or is it not quite a sort of an easy trade to say just buy any old big copper mining company, they're all going to give you good returns?
I definitely wouldn't go and make individual bets. I think going and buying one company for that exposure, there's a lot of risk in that. There could be a strike, there could be an issue at the asset, there could be a pit wall failure, there might be power cuts, there could be an earthquake, there could be loads of things can go on. Management can reinvest the cash that they generate badly, etc. They might cancel the dividend. There's loads of different things that can happen in one company. So a basket approach to me seems to be the best outcome there, and that's obviously what we try to do in the trust. You've referred to projects. I think there are projects out there. So projects in my mind is things that aren't yet producing. But where the real value is today is in buying the existing production, because that existing production is trading far cheaper than the replacement cost. So you can go and buy copper equities today that trade at a fraction of what it would cost to replicate that supply by building it from scratch. And if the replacement cost is dramatically higher than what you're paying for the equities, that through time, then that equity value will catch up. And in the meantime, you're generating cash from the existing assets. Whereas if you're just building stuff, you've just got money going out the door every single day to be able to pay for the construction. And we know, sadly, from history, that when people are building things, they often take longer and cost more. And then there's a risk about when you're starting up, does it actually work? I think anybody who's been through a house development will have, sadly, probably some similar experience there.
So obviously we're seeing quite a bit of sort of takeover action in the mining industry. partially because of this reason. It's cheaper to buy another company and acquire their assets and build them from scratch. So obviously, we've had BHP's made a couple of attempts at buying Anglo American. Anglo American itself is trying to merge with Teck. Are you sort of supportive of sort of M&A in the sector, or do you actually think you've got to be slightly careful? Big transformational deals could actually destroy value long term, because there's been a lot of mistakes in this industry with acquisitions over the years.
Yeah, so I think that so I break that down, the answer down into two parts. So in the early cycle of this century, the kind of China cycle that we refer to, there was a long period of time, 2001 to kind of 2004-5, where the industry didn't really believe that commodity prices would be at elevated levels for a period of time. So they just sat there without spending. Then they kind of all drank the Kool-Aid. They all believed the price was going to be high forever, and things were probably going to continue going up. So they all started to buy each other and build things. That resulted in a huge amount of debt that was taken on to afford to be able to do those things. And then we got to the peak in terms of Chinese rate of growth in demand. And then things rolled over 2010, 2011, and we had 5 years of problems. And that was the kind of cycle at that point, that kind of rise and then fall. During that kind of down period, there was a lot of management change. There was a lot of shift in power in the companies from the executive to the boards. And then from kind of 15, 16 onwards, kind of the last 10 years, we've had a much better period of capital discipline, where management teams have been more focused, they've been more transparent about the decisions they're making, and they've done it under the governance of the boards, and that's been really helpful to restore trust between the companies and their investor base. That situation persists today, where companies are continuing to evaluate opportunities, whether it be M&A or building new things, but they're doing it through the lens of being able to communicate that to the market and to their shareholders to say this is going to be a successful decision. If we look at some of the most recent things, so the construction of the big new mine in South America, Quebrada Blanca, the second phase, QB2 they call it, that project has taken way longer to finish. It has cost more than double what it originally was planned to do so, and it's still not producing at full capacity. And so that to the market says that there's risk in building new stuff. There's risk in terms of operational and financial, and therefore, people have got to think about that when committing capital. And I think lessons from that, and I'm using that as one example, but there are plenty of other ones as well, is kind of holding people back because they realize they need a bit more margin of error in the price to be able to get those returns. And we don't see that in today's copper price, for example, and some of the other commodities. So right now, I think that the industry is sitting there. For most companies, they're enjoying the cash they're generating. They paid off the debt many years ago. They're paying out really healthy levels of dividends, and they're kind of looking around to see what opportunities might be there. I think the point you made earlier on is very real. It is much cheaper to buy than build, even including the premium you have to pay to get control.
Yeah, you mentioned China earlier on about being sort of a key component of part of the previous commodity cycle, driving up prices. Where does the market stand at the moment in terms of, is it still heavily dependent on China being the major customer for commodities, or is there sort of demand dynamic shifting, perhaps spreading around geographically? It's not so dependent simply on one country.
Great question, and there's lots of different ways to answer that. So the answer is yes, China's still the biggest consumer, so therefore the market is dependent upon that. What's interesting, though, about Chinese demand is it's shifted domestically away from just the residential orientated demand, which was the driver of the previous cycle, that rural to urban migration, etc., and the associated spend when you move into a property of dishwasher, air conditioning unit, and so on, to much more of an industrial spend. So it's about building the grid, it's about building the renewable power sector, it's about electric vehicles. So it's much more of an industrial spend that's driving demand growth than the kind of property related stuff. And there's been a shift in that has taken place, but the investment market is behind the curve on that. So when a Chinese property number comes out and it's negative, you see commodity prices go up or down, whereas actually you don't see the same correlation when an industrial number comes out. So we're in that kind of transition period itself where people are starting to get used to the new drivers. And I think that's kind of an opportunity for us, because we see that and we realize the market might be a little bit behind because they've still got that muscle memory from the previous cycle. that is one element of the answer. The second element is in the previous cycle also, China was in many years more than 100% of the demand growth. So the world's commodity market was kind of dependent upon that. What we're now seeing is obviously massive infrastructure spend in the US and Europe, whether it's data or it's power and all this, the move to digital, that's driving the consumption growth of commodities in a way that wasn't there in the previous cycle. So from a percentage of demand, the numbers haven't changed that much. But in terms of the contributing factors to demand growth, the rest of the world, the developed world, is a much bigger component today and likely to be so going forward than it was in the previous cycle. So when you think about what's driving commodities demand growth, it's much more balanced today than it was in the previous cycle, which is actually healthy because it makes it a more robust cycle.
Excellent. Well, Evy, thank you ever so much for talking through what's going on. So Evy from the BlackRock World Mining Trust. Great to talk to you.
Great. Thanks so much.
Well, brilliant. Thanks for doing that. That's excellent. So we've got loads of good stuff in that time. So thank you very much.
Good luck cutting it down to 10 minutes. Yeah.
Thanks again to Evy Hambro from the BlackRock World Mining Trust.
All right, we've got time for one more segment, and it's a real topical one. So markets have been a little bit wobbly over the last month, and understandably, investors are starting to ask, what should they do? Or certainly, what should they think about if markets do fall back? So Hannah grabbed some time with Nick Britton from the Association of Investment Companies to explore the companies in the investment trust space that pursue a capital preservation investment strategy. So to understand exactly what that means, and also sort of the names that are relevant to the theme, let's hear from Nick now.
Hi there. We're with Nick Britton from the AIC. How are you doing this morning, Nick?
Oh, really well, thank you.
Awesome. And we're here today to talk a bit about capital preservation trusts, which haven't always been all the rage, but at the moment are getting quite a bit of attention, especially as people are getting a little more nervous with some of the bigger markets and AI and a lot of the things that have really been driving returns in the past couple of years. So I was having a look at one of the most popular capital preservation trusts this morning, which is Capital Gearing, and they are right now only trading on a 2.29% discount. They're also up 5.5% this year versus the past 3 years. Their share price total return is 4.6%. So I think that gives a really interesting look at what the environment is shifting towards. And I wanted to hear about that from you, Nick, and just get an idea of what is happening right now and why is this sector starting to get some more attention?
I think the first thing to say is that these trusts, like Capital Gearing Trust you mentioned, also I could throw in another couple of names, Personal Assets Trust and Ruffer Investment Company, have been around for quite a long time, actually. And they're sort of perennial favorites for people who are a little bit nervous about the market. And I think you're right. They're particularly relevant at a time when people are talking about an AI bubble. Now, I don't know if we're in an AI bubble. Nobody really does. But people are certainly starting to worry about it. I mean, there is a school of thought that if people are worried about it, then maybe we're not really in it. But who knows? So if you are worried about that kind of thing, or you just think that stock market valuations are quite high, which I think in the US is not really debatable by historical standards, they are very high, then, these trusts are putting themselves forward as a natural home for your money, because, what they're trying to do is to smooth your total return. So, your share price dividends together, to smooth that over time, to reduce the risk of down years.
Yeah.
Now, they have had down years occasionally, but they have a lot fewer down years than a fund that just invests completely in the stock market. For example, Capital Gearing, which you mentioned, it's had 2 down years out of about 40 odd years when it's been run by the current team. So, and when they do have a down year, it tends to be a few percent. Whereas, as you know, and as listeners will know, if you invest in the stock market, you could have a down year of 20 or 30 or even 40%.
Right.
Not that often, but it can happen. So that's why people like these trusts, because they they're looking to grow money, but they're looking to protect it, and they're putting the protecting objective before the growth objective, whereas most funds might be the other way around. So yeah, they are popular at the moment, and I can see why. On the discount front, they do have zero discount policies. So they do tend to buy back shares when they go to a discount. They tend to issue shares when they go to premium, just to keep that discount as close to zero as possible.
Yeah. And so, talking about that appeal of being a more low risk option, what makes them low risk? What are they holding that makes it so much more low risk? And it has, as you said, it has been quite effective.
Sure. I mean, what makes them lower risk? It's the mix of assets they're holding. It's not what assets they're holding, it's the combination of the assets together. So in fact, they all have some exposure to big US tech companies, or certainly Ruffer and personal assets do. For example, personal assets has 5% in, I think, Alphabet, Google, basically. Ruffer in Amazon. So they do invest in those companies, but then they combine holdings in equities with holdings in bonds. And especially they quite like index-linked bonds, which are bonds where the principal and the payments rise with inflation. And in fact, all these three trusts we're talking about, capital gearing, personal assets, Ruffer, are very focused on inflation. In fact, you could almost say they are quite nervous about inflation and have been for a long time. And so they do make a good home for your money also if you share that view and you are nervous about inflation. So holding index-linked bonds gives them some sort of protection. If inflation rises very rapidly or in a sort of unexpected way. They also have some cash, not too much, but a bit of cash. And they have, all three of them, a bit of exposure to gold, which of course is a classic sort of safe haven thing that you hold if you are really, really worried. They don't have a lot of gold, but they might have a few percent gold. I think one of them has sort of 10, 11% gold. That's the highest. And what they do over time is they sort of adjust their exposure to these different assets depending on how they feel about markets. So, for example, all three of them at the moment are fairly defensively positioned relative to, I mean, they're always defensively positioned compared to straight equity fund, but even relative to their own history, they're quite defensively positioned because they're all quite worried about these high equity market valuations, but they'll flex those exposures over time. And the way these portfolios are designed is that if one asset does really, really well, another doesn't do so well. But then almost whatever happens, this is the idea anyway, almost whatever happens in the markets, they're protected because one or other of their assets will be doing well.
Right. Yeah, it's surprising to me that there's so much holding in things like gold and some US equities, especially because those can be seen as more volatile asset classes. But that structure focus is interesting.
It has been, hasn't it? Gold has been a very volatile asset class, and it doesn't always do very well. And there are periods, some multi-years periods sometimes, where it does terribly and it keeps losing money. But I suppose the point of gold is that it does well when everything else does badly. So if you have a financial crisis type situation, equities and bonds are supposed to kind of balance each other out, aren't they? So equity is supposed to do well when bonds don't, and bonds supposed to do well, but that doesn't always work. If everything does badly, then gold steps up and becomes your insurance. On the other purpose of gold, of course, is if you're very, very worried about governments basically printing too much money and sort of over time debasing their currencies. So yeah, you're right. Gold is a super volatile asset, but it's a kind of portfolio insurance.
Yeah, absolutely. The index linked element is also very interesting because I think a lot of people would see the returns at the moment for these funds and say, okay, well, I can get quite good rates on cash, so I'd rather do that. What do these kind of offer in the long term that cash maybe isn't offering?
Yeah, I think you can get good rates on cash at the moment.
Mm.
And you can get rates on cash that are just above inflation if you're prepared to move your money around and look for the best rates.
Hmm.
But I think what these funds will do is over the long term have a target to preserve the real value of your money, ahead of inflation over the long term.
Hmm.
And there's been very long periods, we've just come out of one, where it's been very, very difficult to get a return on cash that's more than inflation. And what they're trying to do is they're not just trying to, beat inflation a bit, but,
Yeah.
beat it more substantially, more significantly. So whereas you mentioned performance, they are not, these trusts are not going to be the top performers in any one year.
Right.
Very, very unlikely that they're going to
Right.
be the top performers. Very unlikely they're going to be the bottom performers either. They're not the trusts you hold that if you want a really kind of big growth focus or a sort of really exciting ride.
Hmm.
But they are going to, if cash is at one end of the spectrum in terms of safety and sort of growth potential, they are a little bit further along that spectrum. So we would
Right.
hope, over time, and they have, by the way,
Yeah.
over the long term, they would do better than cash. But in an individual year, of course, they might not. And of course, we should say, to be sort of responsible, they are stock market listed investments. They do go down as well as up.
Mm.
And they are managed in a low risk way,
Yeah.
but of course there can't be any guarantees with any sort of investment,
Right.
and there aren't with these either.
Yeah, that makes sense completely. Yeah. And I think the last question I had for you was, there's been a lot of discussion about, especially among active managers, of what really makes something contrarian and different, and maybe a bit of pressure in some bits of the industry to hold, these big names that have made such massive returns in recent years. When you're looking at different trusts, what signals to you, okay, this is actually something different? This is actually a contrarian holding that would diversify a portfolio?
Yeah, you're absolutely right. There's a lot of pressure on fund managers to hold the big names, because if they don't, and if then those big names do really, really well, which is exactly what's been happening, of course, over the last few years, then they underperform. And even if they're nervous about those big names, they often don't want to go too far away from them. They might underweight those big names, but they often don't want to hold nothing in those names because it's dragging them too far away from the market benchmark, and potentially they're going to underperform too much. Now, I think you can find contrarian trusts, and I think these three really kind of fit that description.
Yep.
Actually, because all three of them have a very clear philosophy. I mean, capital gearing has been managed by a guy called Peter Spiller for 43 years, I think. He's our longest serving manager in the investment trust space. We think he's probably the longest serving manager in the UK, full stop. We don't know that for a fact. And he has, it's truly amazing. I mean, the number of market cycles he's seen, and the experience he's got is amazing. He's also backed by, a really strong team. And they have a very, very clear philosophy. And if you listen to him explain it, you won't really forget, because he's got a very sort of clear way of putting it as well. And, they have stuck to that philosophy. And you say, what makes you contrarian? It's being prepared to stick to your philosophy when actually it's difficult. That's a difficult thing to do. And you're underperforming other people. And, despite that pressure, perhaps to sort of do what everyone else is doing, follow the herd, you kind of resist that, and you're prepared to be unpopular. So what you'd be worried if somebody said they were contrarian, and then in a big bull market, they performed like everyone else.
Right.
And these three don't. If you look at their performance, they don't perform like everyone else. And that's what they're designed to do. And I think they've been very, very clear about that. And I think people know what to expect when they invest in these three trusts.
That makes sense. Yeah. Yeah, I guess it's one thing to have those rules, and it's another thing to really be able to stick to them. So that's quite good.
It's very nice to say that you're a contrarian. It's a very difficult position to be in, especially for extended periods of time when markets sort of persist in, some kind of mega trend like we see with the Magnificent Seven.
Yeah, absolutely. Yeah. I think that's all I have for you today, Nick, but I just wanted to say thank you so much for coming on and speaking about this. It's always a pleasure to talk to you. So thanks.
Not at all. It's a real pleasure. Thanks, Hannah.
So that was Nick Britton from the AIC. And that's all from us on this special episode all about investment trusts. We'll be back with the usual AJ Bell Money and Markets podcast later this week. Until then, thanks for listening if you prefer the audio version, or thanks for watching if you've got our videos on YouTube or Spotify. Don't forget to hit like and subscribe, and we'll catch you next time.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.